Hi, I'm Karen Ward.
And I'm Hugh Gimber. Welcome to JP Morgan Asset Management's Markets Explained.
Your weekly briefing, where we cut through the noise and focus on what matters most for investors, setting you up for the week ahead.
Today we're going to break down what you're zen about and what you're not. A reminder, Karen, this is strictly markets and macro rather than...
So I shan't talk about my teenagers.
Well, we can leave those to one side for now. But yeah, on that vein, let's start off with, on reflection, what are some of the market issues that we've been dealing with that you're feeling happy about and no need for us to be too concerned?
So I think we'll start off with, I'm very comfortable that the central banks aren't in a new hiking cycle. There was fears of that earlier on in the year as oil prices started pushing up. And they're talking still pretty tough. We've heard warnings still from many of the central banks that they're very vigilant, and I'm sure they will still be sending those warning signals, but I'm very zen about them keeping rates on hold through the remainder of the year and generally bond markets not providing us with too much to worry about. So that's the first thing on my list of things I think I'm feeling pretty okay about.
Definitely. And if you were closely following payrolls on Friday afternoon, I suspect that data would have made you feel even better about that. We had a very soft print in the US economy, minus 23,000 jobs being added, or should I say 23,000 jobs being removed from the US economy last week versus 80,000 expected. And some major revisions to previous months. So we lost another 100,000 jobs after those revisions. Obviously, difficult for those involved, but from a Federal Reserve perspective, buys them a little bit more time to see how the economy is playing out. But obviously, we have data this week as well coming out on Wednesday. You've got US core and headline inflation. Is that something that you think could lead to any kind of market swings, Karen?
It certainly could. If we got a horrible surprise on core inflation, then I think the market would certainly think, oh gosh, maybe the Fed is going to feel like it just has to act to show that it's awake. But, as you said, it wasn't just the jobs lost in that labour market report. It was wage growth at just 3.2%. So if headline inflation is what the market expects of 3.4, then real wages are declining. And therefore, this is not an economy that's overheating or has an ability to generate sustained inflationary pressure. So it certainly always could. Inflation's always one to watch. The market expects a slight moderation, so not expecting it to reawaken me from my zen-like state.
Ian reminded us last week that there are 2 payrolls prints and 2 inflation prints between these 2 Fed meetings. So definitely a tick in the box from an inflation perspective on that wage number, as you said. This week, the first of those 2 inflation prints ahead of the September meeting. But notable, I think markets now pricing less than a 50% chance of a rate rise in September from the Fed coming off the back of last week's softer wage data, as you say.
Yeah, and I guess, on the subject of inflation, the other thing I just feel increasingly comfortable about is the impact the Middle East is going to have sustainably on commodity prices. I just find it remarkable that with all these ongoing uncertainties, is there a deal? Is there not a deal? Is the Strait open? Is it not open? I walk in this morning and oil is at 83. The energy markets are functioning. I still believe something is going on in these energy markets, which is sending us a very positive signal about the supply of energy versus demand for energy. I still can't put my finger on what it is, whether it is the fact that now that we've increasingly electrified our systems, we don't need oil and diesel in the way that we did, whether it's China's demand, whether it's new sources in North America, whatever it is, oil I don't think is going to be what trips us up in the remainder of the year. And, again, we'll be watching, I'm sure, the various tweets and tit for tat over the coming week. But I think what we have seen time and time again is the appetite on either side, not just the US, but the Iranian side, to tilt this from tit for tat into a much more significant escalation is just not there. And so that's going to be one of the things as I try and remain zen, I'm going to put towards the back of my inbox.
I think it's interesting on that note that in the weeks where oil prices are down significantly, often it's off not a huge amount of news. And you need a lot now to push oil prices higher. So if I think about what's happened since you've been out, last weekend, i.e., 8 days ago, we had an announcement from President Trump that he was postponing the attacks that were previously planned in the hope of an imminent deal. And we saw the attacks postponed. We didn't see the imminent deal being struck. And yet, as you say, here we are again with oil prices back in the low 80s. So it certainly feels like we're in a world where for oil prices to be pushing materially higher, you need to see real escalation. And just the passage of time, just another week going by without anything getting worse, is enough to keep that oil price just drifting lower.
Yeah. And then I think the other thing I really reflected on, and I should say my subconscious works on work. It's my conscious working on other things, including some great books that I read. But my subconscious really thinking about one of these big questions about this new world that we live in. You know, it is just more politically chaotic, more fractious. You know, relationships between countries and governments are just not as clear as they were where the alliances are. And that emotionally makes you think that this is going to be bad news for markets. But I increasingly think that actually what we're going to learn is this is just a very good time. This is going to be a very good decade to invest, purely because that fractious environment is actually just creating a lot of spending, whether it's governments spending a lot more, or whether it's companies spending a lot more. There's just a lot going on. There's a lot of activity. And that activity, generates growth. You know, when governments are spending, that generates growth, and that's good for corporate earnings. But also, all that activity needs capital. Borrowing, it needs equity, debt instruments to fund it. So as investors, as providers of that capital, we're just going to have a lot broader opportunity set. And, you know, one of the things I checked when I came in this morning was, you know, the performance of the different markets. And, you know, once again, we just see these European markets just ever so quietly, continually creeping back up. And, you know, we're now on, I think the S&P is up 13% year to date, but the Euro Stoxx 50's up 13%. So again, some of the opportunities that are new and broadening, I mean, within that, you know, we've got some big movers within some of the different European benchmarks. So this is paradoxically, you know, we have to put our emotions to the one side. This is actually going to be a great time to invest, but the opportunity set and where the best opportunities may be in this new world could be quite different to what they were 10 years ago.
And looking shorter term, I think that's pretty consistent with what we're seeing from earnings season as well, where you've got the US season starting to wind down now, Europe also having reported the bulk of its numbers. And I think it's notable that while the tech headlines have obviously dominated, the median stock in the S&P 500 is doing really well. Earnings growth for this quarter of 14%. Similarly, in Europe, we're seeing decent numbers. And so I think it's notable that what was at the start of this year a very narrow story is just beginning to broaden out across sectors. That demand for capital, demand for M&A, for example, really helping out the banks this quarter as well. So there's a lot going on here, which is more positive than just some of that sort of headline concern around the tech and the semis volatility that we've been tracking. On your not Zen list, Karen, or is it unzen, dis-Zen? I'm not sure, but the more worrisome parts of the market, where were you spending time thinking last week that actually is a bit more of a cause for concern?
I still think we have to acknowledge that we are coming back to what I said. We're in a slightly new chapter in investing, and that's partly about different spending, different geopolitics, but it is also as much about a transition from a creation of a new technology to the deployment of a new technology. And, you know, this is where I think there are lessons from 99, 2000s. There are many reasons why the current tech cycle is different. But what I think I did learn back then was that the creation of the technology is the sort of easy part. It's the exciting bit where your information comes from the CEOs who are running these companies, and you take everything they say as given. They tell you this is going to change the world and they're going to spend billions of dollars in creating the technology, and everything goes up accordingly. And then when you get into the deployment of the technology, this is just when it all becomes more difficult. And you did some really interesting work, Hugh, while I was away, and I was looking at some of the charts you sent around. And I think we're really seeing that shift in this new paradigm of the tech cycle, because we're seeing two things. One, much more volatility as the market's really scrutinizing, well, hang on, are you spending exactly as you said on the podcast last week? Well, if you're spending hundreds of billions of dollars investing in this technology, have you got demand for it? You know, the market's kind of really now combing through the evidence it's getting, not just what the CEOs are telling us about how transformational it's going to be. But the other thing we're also starting to get information in the markets judging is on who the eventual winner might be. And so I think that just, to me, where it could shake me out of my Zen-like state is just some of the volatility that provides. It's not a reason, I don't think, to be negative, but it is just this new stage. And I think I would feel slightly more comfortable about how investors will feel through this new stage if tech wasn't just such a massive part of these indices. I mean, remind me, Hugh, what are the latest numbers on tech in the S&P and then what the US is in ACWI?
Yeah, so we're close to 40% of the S&P 500 in the tech sector today. And then in terms of the US as a share of global equity markets, that's around 2/3, about 65%. So this is definitely something that we've been experiencing over the past few months, as some of these swings in individual names are then driving global indices because they've become such a big part of the market. Those charts that you referenced just now, Karen, I was looking at this last week, and I think here it's all about the volatility that we're seeing within tech. It's not just now a story about tech versus the rest, but the dispersion that we're seeing between, for example, the hyperscalers and the spenders of that CapEx versus the semiconductors, who are a big recipient of that CapEx, is really picking up quarter on quarter. And it's exactly to that point about investors really trying to focus on where the long-term winners will be, and bluntly finding it really hard to answer that question today. I still think, if I knew that in 5 years' time, I wanted to either be a buyer or seller of computing capacity, life would be a lot easier. Because if I think that computing capacity is over commoditized, I know that I want to be a buyer of it. If I think it's going to be in short supply, I want to be a seller of it. But any kind of forecast about how much of this stuff we're going to need is, dare I say, largely guesswork at this point. So yeah, a lot that we're still learning. But overall, I think against a backdrop of where that activity across the wider economy is supporting the median stock in the index.
Yeah, and as I say, therefore, this is really an exercise in managing volatility. And what do we know are the basics of managing volatility? This is when you use spreading your eggs across the basket. So whether that is spreading them across the big tech names, spreading them between the hyperscalers and the inputs, the semiconductors, the memory, etc., so that you're not so entirely leveraged into just one particular name, which could get really swung about. So that's one thing. I guess I've still got my eye on what's going on over in Japan. Still makes me a little bit uncomfortable. Obviously, as I was heading off on my travels, we had the Bank of Japan intervening to try and stop the decline in the currency. And I do just think the problem in Japan is just policy is inappropriate. It's inappropriate in terms of generating price stability. Inflation is picking up, but it's broadening. It's broadening across core inflation. It's broadening across wage inflation. So incredibly low interest rates are no longer appropriate. But we know the government wants interest rates to stay low. The Bank of Japan is really caught between what the market wants, which the currency is really evidencing, versus what the government wants. I personally think intervening, it's a little bit like this wasn't the kind of holiday where I have that problem, but normally when I come back from a holiday, my main problem is sort of doing my belt up And assuming the problem is, the belt, the underlying issue is that policy is inappropriate. And post-holiday, it's usually my waistline that's inappropriate. And it has to be solved. And it will either come through in the currency or it will come through in the bond market. And Japan is very important for global bond markets. So I'm hoping they give me quite a while before, and to be fair, they are managing this process with the interventions and it's not upsetting global markets just yet. So long may that continue and keep me in my Zen state.
Hear, 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 hear. But I think, obviously, as you say, that September Bank of Japan meeting now becoming a much more of a live issue. Markets having that at about a 50-50 chance of a rate rise from the Bank of Japan. Karen, before I say anything inappropriate about your waistline or belt sizes, I think it's probably time to wrap up this week. So on that list of what you're zen about, feeling zen about the low risk of us being in a new hiking cycle for the central banks, feeling zen about the impact of oil prices on the global economy, and feeling generally, I think, pretty positive about the return prospects generally as market breadth starts to improve. On your less zen list, you had the volatility that we're seeing in tech now as a part of the story, really, as we learn more and more about the winners and losers, and then keeping a close eye on Japan as well. Should add, we had the Guide to Alternatives published at the back end of last week. So do please dig in on that on the website. That's available across Europe. And Karen, you mentioned you read some good books last week. Do you want to leave us with a book recommendation for anyone listening?
Oh, I'll give you two. So Theo of Golden, which is Alan Levy, I think. And then a title, such a weird title, which was Leonard and Hungry Paul. And it's quite a quick read, but I just found it absolutely marvelous. Just one of those soul-enriching books. Leaves a smile on your face. So yeah.
Perfect. A good place to finish. Thank you everyone for listening, and we will see you next week.
Thanks a lot.
This communication is educational in nature and not designed to be taken as advice or a recommendation to buy or sell any investment or interest thereto. It is based on assumptions in current market conditions and are subject to change. It should be noted that the value of investments and the income from them may fluctuate in accordance with market conditions, and investors may not get back the full amount invested. Past performance, yield, or forecasts are not a reliable indicator of current and future results. JP Morgan Asset Management is the asset management business of JP Morgan Chase & Company and its affiliates worldwide.